think the market is expensive by historical standards. The multiple is several multiples higher than the long-term average. And that would be fine if earnings were growing above average and the economic outlook was really attractive, or we were expecting material drops in interest rates. And economic growth is below average, and the Fed is showing no evidence that they're going to lower interest rates anytime soon. So you take those two situations and you look at above average equity multiple, that tells me it's expensive, and I think you should be cautious.
Melissa, you jump in if you have any questions,
Okay, so to like the layperson, what that means now is not a great time to be buying. Now is a great time to just sort of be playing it safe with, is that what you're trying to say?
Yeah, I think the promoters of stocks will tell you that you should buy every dip in the stock market because on average over the last 80 years that's worked, which is actually correct. But it's not correct when the market is very expensive. And for example, the last time the market as a multiple was this expensive was early 2000 after the tech bubble. And the S&P 500 took 14 years to get back to the peak it had in March 2000. And so there are definitely times, on average, if the market is cheap, you should buy every dip. But when the market is expensive, buying the dip becomes dramatically riskier. And that's, I think people should be more cautious. They should have less equity exposure. They should have lower beta stocks. And even though the bond market hasn't performed and there's a lot of worry about inflation, you probably should own more short duration investment grade credit than you would normally. That's the things that have worked over the last 80 years in situations when the stock market is this expensive.